Hello and welcome to the Silver Log. It is the 1st of May 2011 and the topics for this video are going to be mixed. A lot of things that I missed on the Saturday videos as well as some rare stock market analysis. So let's get started, and I want to start off with a question that I received, and it says, "Hello, Derek. Thank you so much for providing this channel. Quick question: can you recommend some books with regards to technical analysis? I graduated with a finance degree last year, and I find this subject extremely interesting. I would like to learn as much as possible about this field." Okay, Darren, and I've never ever read a technical analysis book before, so there's only one that I can recommend, and the only reason I can recommend it is because I know the author, whom is the one who taught me, but I used his videos. He goes by the user of Thermal1 on YouTube. His name is Brian Shannon, and his webpage is alphatrends.net. He wrote a book called Technical Analysis on Multiple Time Frames. His motto and his the way I like about his procedures within things is he comes with a neutral approach and is really big on risk management as well as price action. So if there was any book that I would recommend, it would be that one in particular. You can go down to alphatrends.net. And how correct is technical analysis? Mike Maloney has been stating that technical analysis is right about 55% of the time. And my response to the correctness of technical analysis is as long as the data and calculations used within the charts and indicators, then technical analysis is going to be right 100% of the time, as long as the data and calculations are correct. It doesn't matter if it's a manipulated market or what fundamental news is reflecting the price. The moving averages don't care, as well as the Fibonacci and the RSI and so on and so on. Just because technical analysis is right 100% of the time doesn't mean you will win every wager. If you get stopped out on a long position, then technical analysis will state it to be that of a bull trap. The winners are the ones whom use technical analysis the most effective, and thus the ones whom are the most skilled at doing so. Many gamblers will lose on wagering on stock code betting because even though they are using technical analysis, they may not be that good at it, and thus struggling when playing this casino game. And I'll get more into the gambling aspect very soon. The more you know, work, and prepare, then the better you should do on your return on investment. You can think of it this way. Imagine a football team who spent so much time going through strategies, analyzing situations, and just working their bones off to get the job done, playing against a team that worked half-assed. Who do you think is going to win? It's the ones who put the most work in it, and if you can put the work into it and be skilled at the same time, then results should show. Alrighty, next one. When should I buy silver? I want to buy, I just don't know when. Waiting for a pullback can be a very difficult thing to do because sometimes it just doesn't happen. You see the price of silver breaking 30 in the earlier part of this year, and you wait for a pullback so you can load the boat. Now, those people who passed at 30 are now hoping to buy back at 40. It may happen and it may not. If one wants to load the boat, aka also known as buying a lot, on a pullback, then why not buy in segments and buy on the way up or down? Instead of buying everything at one shot, buy a 10% and then another 10% and so on and so on. If the market pulls back from 50 to 38, then this should create a dollar cost average at around 44. If you buy on the way up from 50 to 70, then a dollar cost average should come in around $8 or $60. If you're looking to buy sometime soon because you want to turn your extra pay to silver or any other reason, then let the message of the market tell you when to get in. Wait for the market to break out above a rising 5-day average or the market to hit a key Fibonacci support level. It's up to you, and this channel provides direction on how to analyze trend for educational purposes. So, for example, let's just take a look at this hourly time frame. Maybe you want to see it break this downward trend line and then find a way to break above some significant resistance and then buy. Or maybe you want it to come back down to this level. Because some people get paid every 2 weeks or every month, and once a month or twice a month they want to buy silver. If that's the case, no, most of the time you can just buy whenever because it really doesn't matter if you're buying it for the long term time frame. But if you're trying to save a little bit here and there, it can make it a little easier to just make your dollar cost a little bit better by waiting for key triggers to get in and out of the market, or mainly in. Getting out, of course, is, as I would predict, when everything gets out of control, currency's dead, then now you got what you need. A lot of times when you hear people talking about stock markets, they'll talk about the risks associated. I did a Google search for trading involves risk or something like that, and this is what I came up with at a web page. And it says, trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. Only risk capital should be used when trading futures or options. You must review customer account agreement prior to establishing an account. Investors could lose more than their initial investment. You must review customer account agreement prior to establishing an account. This is at some web page. Past results are not necessarily indicative of future results. The risk of loss in trading can be substantial. Carefully consider the inherent risk of such an investment in light of your financial situation or condition. Same thing. I'm not a big fan of the way this is written. I've written another one below, and well, I'll read it now. Stock market options and so many of these investment vehicles contain risk because it is gambling, sort of like playing blackjack at the casino contains certain risk. It is very unfortunate that brokers are not called bookies, and when someone makes a trade, they don't state they are making a wager. Many brokers, which should be called on like casinos, will use slogans like "get invested" instead of "get gambling," which the author finds very disturbing. The author is me. This might be because the powers that be would realize that if the people knew this was a form of gambling, then they may not want to participate in the equities market, and it would be nice if E-Trade would state betting on stocks are very risky and may contain certain losses. Gambling on these codes can make you a lot of fiat dough or lose you a lot of fiat dough. When gambling with our firm, please remember that Goldman Sachs uses high frequency trading, which makes it harder for you to win. But you can do it! Happy gambling, and if this gets out of control and you feel like throwing a shoe on the screen because you got stopped out, please contact Gamblers Anonymous. There we go. Enough of this type of thing. Now let's get into some other aspects. I want to talk about the bid and ask spreads a little bit and talk a little bit about spot MEX. Now, the way the free market works is you have bid prices and you have an ask price. What the bid price is, these are people whom are looking to sell who have that product. And the ask price are people looking to buy and the price they're offering. Therefore, in this example here, you have 1,000 people whom are selling at 56, 750 at 57, and so on and so on. These things change as people buy and sell. For example, if somebody comes in and they want to buy 1,750 right now, they would have to buy 1,000 at 56 and the next 750 at 57. So essentially what would happen is they would take out these in here. Now if you want to buy it, it would cost 58. What would happen is some people would see this and they're like, okay, wait a second here. The price is going up. I'm going to say this person in here who's got 250 at 52. Let's just say he changes his order and he's like, you know what, I'm going to go 56 now. And then this person here changes their order. or somebody else new comes in and says, I'll go 57. And that's generally how the free market prices will change back and forth. Now at SpotMix, they allow you to buy and sell gold and silver in this form where you can put bid orders in for your metals, and if anyone takes it, you have yourself a sale. If you put an ask orders in, and if anyone is interested in selling, then you can get the transaction that way. You can also set it up to sell based on a percentage of the spot. Now, overall, I'm not a fan of the spot price, even though I cover it like all the time, because the reason why it's so cool that we do have that spot price is because I can fool dealers. I can buy silver at under $400 right now because they're using the spot price. Now let's move on to the next little subject, and that is the topics that I didn't go over on the weekend. One of which is the comparison for silver from 1979 to now. We're moving into this range of 150 to 200% gains from the breakout level. 150% to 200% should mean that as long as it can hold above 40, then this comparison will keep on continuing going wild. And there was a lot of volatility in here, and well, volatility is increasing right now. As I've been talking about, the volatility index that I've been really talking about, or showing anyway, it calculates the difference from the highest and the lowest points that it trades. This is on the hourly time frame, and it's obviously in comparison since the 1st of March, it's at the highest volatility that's ever been. You can see it's just much, much greater, sort of like the volume. Same rules go as I was talking about the volume, as in either it's going to create an intermediate term top or that major upward price explosion. The daily time frame for volatility using the similar kind of calculations. It's different story. Look at this massive volume or volatility in here, yet the index is pretty much the same all the way. The reason why it was so high was because it was coming down from its previous levels back in the 2008 into the 2009 early parts during the bottom period. But as far as what we're seeing now within this homemade index variable, you can see that roughly around the 70 level is where it can't get above. That's the it seems as if it's going to be going higher than that, thus an increase of volatility. If we switch this up to the monthly term time frame, this was the volatility from 1980. Let me just get my okay. This was the volatility from 1980. We are obviously are not at this level yet. We could easily surpass it, but things are not as wild as they can be. Now I want to talk about the Dow Jones index. A lot of people think that the Dow Jones is just a time bomb waiting to happen. Remember what the Dow Jones is priced in. It's priced in dollars. You're going to be hard pressed to find almost anything that's a real asset of some sort going lower priced in fiat dollars. With that being said, the market is bullish. Now it says silver log in here, that's what I'm writing. I personally wouldn't want to get invested in it or gambling in any one of these types of events because, well, you have to deal with a financial institution. I'm not a big fan of that, but if you are, go right ahead. The market has been breaking out. It's got past the resistance level here, and now it may need to come back, but it's had some nice up candles in a row. Definitely at a bullish trend. No reason right now to say that the market's going to retrace for a significant level as of now. On the weekly time frame, this is very bullish. Ever since the market turned around in here, it came back down to the 18-day average of highs, exploded again, had another correction in here. It's moved higher, another test of the average here, and it's just breaking past this level. No reason whatsoever to signify this as bearish. Next chart is the monthly chart. And on the monthly chart, this is again bullish. Now there was a large capitulation mode here, seeing the market fall from about 13,000 down to 6, but it's recaptured those levels. What does this tell us? Well, within this Fibonacci, it found resistance here, came back, found a higher low, got above it, but didn't hold. but it did find support at this average, got above the Fibonacci, and is now exploded to the upside. What does this mean? It means this selling is a failed move. It showed confirmation of getting above this key Fibonacci level. Therefore, the selling is a failed move. Oftentimes, from failed moves, create fast moves in the opposite direction, which should result to Dow in the 19,000 range as an approximate level. Reason why? Because of inflation. Alrighty, the quarterly time frame. Overall, this is pretty much a neutral market. I got newly bullish in here because, well, it was not bullish in here. It was kind of bearish. It was neutral in here, and it's just broke neutrality by this candle here. So this quarter, it has went from pretty much into the newly bullish stage. But overall, if you adjust this for inflation, we are experiencing one heck of an invisible hidden crash, because on an inflation adjusted level, this baby is extremely bearish right now. And now let's finish it off with the yearly chart. And the yearly chart is extremely bullish. We last found, or in here, we found some nice support back in the 70s. And then it came back down here again. The path of least resistance is higher. Once again, reason why? Inflation. This was a very significant trend line that was going up extremely high. It's been broken. If we do have any corrections, we have this Fibonacci here at 2600. But even maybe roughly here towards this level here, you got to expect that if it retraces, it's going to go pretty significant above this level. Now, as far as why these numbers, these might say that Fibonacci numbers don't match, it's because it takes the highest point and lowest point over the last 67 days and only shows the last 50 days. And the markets were bullish beforehand, obviously. Once again, reason for this is inflation. Final chart now will be the silver to the Dow relation. Because one thing that I hear a lot is, well, what's going to happen when the stock market crashes within silver? First thing you got to do is change the word if the stock market crashes, what it will do towards silver. Remember, they don't trade together, at least not all the time. If that was the case, then why do the charts look so much different? From 1970 to about 1980, the Dow Jones really didn't do much, where the silver market, was in a massive bull market. Then from about 1980 to 2000, we've seen how the stock market was excessively rallying, where silver was in a major downtrend. They did the opposite for 2 decades. And since then, silver's been in a massive rally, and the Dow Jones has corrected through time. Therefore, every single time since, and there's only been 2 times, but every single time since 1968, when silver has been in a secular bull market, the stock market has corrected through time. Because it did it here, stock market range from 600 to 1,000, and again here, stock markets ranging from 6,000 to 14,000. Plain and simple. Therefore, if the market crashes, will silver crash with it? Maybe, but again, like I say, they don't follow the exact similar patterns. It's comparing the S&P 500 and the Dow Jones, most certainly, but you really can't compare silver and the Dow and expect they're all going to do the same thing, because like I say, when silver's been rallying, it's corrected through time, and when silver sold off, the Dow Jones had a massive rally. Thank you for watching this video, and have yourself a magnificent day. Bye-bye.